Finally, just on the theme of capital taxes, I'd just like to look at the position of CGT, income tax, and compare it really and see what we can do to get into the CGT regime rather than the income tax. For the first time in many years, there is a huge disparity of rates between income tax, the highest rate of income tax, and CGT. It had been mooted in the press that the Chancellor would, in fact, increase the rate of CGT, but he hasn't done. He's left it at 18%. So no matter what asset you dispose of, provided it's a capital asset, you'll pay capital gains tax at 18%. And also, we have this special entrepreneurs relief where if you make what is called a material disposal of business assets, that's shares in a company or assets in a business or your business or part of a business, then you can get a special relief which effectively reduces the rate of tax to 10%. So at its widest point, the difference is paying income tax at 50% or capital gains tax at 10% or a maximum of 18%. So what can we do? Well, we can do some arrangements, usually possibly involving limited liability partnerships, whereby we will look at the assets, and if there is any property in there that we can actually wrap up and sell, possibly intellectual property, possibly goodwill, then we can actually get it out of the company, wrap it up, and sell it effectively to yourself. It won't be yourself, it'll be a vehicle that you then own. And this seems these kind of ideas are quite popular in the city for traders, and in fact we're doing work on a similar proposal, and that's just one way of using it. If you have intellectual property or other property in your company that we can wrap this way, then the idea is that we take it out, we trigger the gain either immediately or at some point in the near future, and the individuals, the owners, will then pay tax at a maximum of 18%. And rather than taking remuneration or dividends or partnership shares out as income over the next few years at 50%, the idea is you make a big enough gain, pay the 18% now, and then use that money to live on for the next 4, 5, 6 years. Like I say, that's something we're doing for a number of clients, and that's just one arrangement. There are a number of things we can do. But we also have to watch, on the other side of the fence, the revenue will be trying to treat capital transactions as income. And although the anti-avoidance legislation in this area hasn't been really used for a number of years because there was no point when capital gains tax was taxed at 40% and income was taxed at 40%, I think the revenue will look at it more closely. And I suppose one of the main areas for scrutiny will be property transactions. If you sell a property, in what capacity are you selling it? Did you buy it with the aim of selling it, no matter how long you bought it, how long ago you bought it? If you did, then technically you're trading and that should be taxed as income. If in fact you bought it with a view to investing, then it's a capital gain and taxed at capital gains rates. What if you bought it with the intention of trading, but then found you can't sell it? And so you take it as investment, you get a tenant in. Well, that gives its own other issues to deal with, being the appropriation of assets out of stock into fixed assets, and also to what extent any income is taxed as trading, to what extent it's taxed as a future gain. And so there are a number of issues, and we need to look very carefully at what transactions that we're entering into to make sure that if we are expecting to pay 10 or 18%, that they are in fact capital transactions. The other good news coming from the pre-budget report is that there is hardly any changes to what we call the venture capital reliefs. That's VCTs, Enterprise Investment Scheme, and the Corporate Venturing Scheme. There's a little bit of tinkering at the edges, but overall, they're still there. And it's important to review any capital gains that you've made in the last 3 years. Because EIS arrangements, Enterprise Investment Scheme arrangements, allows you to defer the tax that you would have paid on a gain made up to 36 months ago and defer it by investing or subscribing for shares, should I say, in an unquoted company. Now, if you do that, let's say you made a gain on your yacht, let's say, and you made a gain of £500,000. and you then invest that £500,000 into an unquoted trading company, and it has to be certain types of trade, then you will not pay any tax on the gain on that asset. The tax effectively gets rolled up, deferred into the shares in which you've invested, and when you dispose of those shares, or if you dispose of those shares, you will pay, that gain will come into play. But there's a very interesting point here, because let's move away from the yacht. Let's talk about a property. Let's say you had an investment property that you sold 2 years ago. And 2 years ago, if it was investment property not used in your business, you would have paid tax at 40% on that gain. If you invest an amount equal to that gain into unquoted shares in a qualifying trading company, and then you dispose of the shares now, that gain comes into play, but you're only taxed at 18% on that gain. So there's a real 22% benefit on doing the EIS. And there are arrangements, and we can put you in touch with some or give you some, where you can enter into a not too risky EIS company, in fact a pretty safe EIS company, and use it in that way. So you save tax at 40%, and when you eventually trigger that tax, it will be at 18%, provided counter rates continue. And so it is very important to review that position, especially if you've paid capital gains tax at 40% in the last 3 years. The very good news is that that's the last slide.